The markets are volatile as China responds to a fresh round of tariffs enacted by the United States. Joining us now to discuss the investing implications and outlook for the world's second largest economy is Haining Zhao, VP and Director for Asset Allocation Research with TD Asset Management. Haining, thanks so much for joining us, and there's a lot going on.
Yes, certainly. Thanks for having me.
So obviously we know that we had the big tariff announcement from the Trump administration, the China reaction. We have the United States just moments ago saying that they plan to retaliate and with an even firmer hand. We're seeing a little tit for tat right now. What's actually happening here and how could this affect these economies?
So clearly things are bad. So the question is, how bad is it? So in terms of tariffs impact on a GDP, you can actually calculate it, two different ways. One essentially is treating tariff as a type of tax or cost, and then calculate as percentage of GDP. As we know, China's have, in terms of export to the US, that's about 3% of GDP. And if you account for the 54% cumulative tariff, that's about 1.5% of GDP impact to China. So in comparison, if you look at some of the other trading partners, some of them are not necessarily smaller. For example, if you follow the same calculation looking at Korea, it's probably the same impact as a percent of GDP is about 1.5%. Japan and EU is a bit smaller because they diversify their exports. So by doing the same calculation, you probably get around half of the impact, as China. But some of the other Asian countries like Vietnam, if you do the same calculation, that's about 10% of GDP. That's a huge hit. Similar for Taiwan, another trading partner. So their impact is double the amount of China. And on the other end, if you calculate doing the same calculation on the US, if you treat tariff as a type of tax, if you are going to collect about 750 billion US dollar additional tariff, that's about 2.5% of GDP. So you can see that number is actually not small.
As we start the week, the temperature between the two world's largest economies doesn't seem to be coming down. President Trump threatening new 50% tariffs on China if Beijing doesn't remove the retaliatory duties off of last week's announcement. How do we expect this to keep playing out? They are not playing friendly at the moment.
Right. I think for now, this tit-for-tat retaliation probably will continue for a little while. But I think both sides probably wanted to leave some room for negotiation, because in the end, when you step onto the negotiation table, your goal is not to do mutual damage. You want to achieve something. So, for example, Trump want to do a deal on TikTok. Trump is a deal person. Same thing for China. China, if U.S. approach China the right way, not threatening retaliation, more retaliation, I think China would be love to negotiate. So I think after all of these tit for tat for a while, both sides eventually will find way to de-escalate the whole thing.
You talked about some of the economic damage while they try to find that common ground to have a discussion where we're not there yet. From China's point of view, what can they do to start offsetting that hit to GDP?
Right. First of all, so when I do that calculation, I purely focused on export. But typically what happens is when export go down, the import also goes down. Therefore, the impact on the GDP is naturally smaller. For example, among all of the Chinese export, around 25% is processing trade. Processing trade means you receive goods from other countries, you process it, and then you sell it back to other countries. So when the export going down, the import naturally goes down, probably the same amount. And then beyond that, you actually looking at fiscal deficit this year, China is penciling a 1% more fiscal deficit spending. So that's a natural offset. And beyond that, I think you could expect further fiscal stimulus announcement from China. I think China is preparing for this worst case scenario.
How big could we expect the fiscal package to be? I just think of the China narrative, and you and I have discussed it over the past couple of years, of investors waiting for that big one, and the big one didn't really come. Could this be the big bit of stimulus from China?
Right. I think the market whisper number is around 2 trillion RMB. So if you calculate that 2 trillion, that's about 1.5% of GDP. And we just did that tariff impact calculation. 1.5% is basically, if not entirely offset, it's offset 80-90% of whatever impact is. And if you look at the commentary from the two sessions on the National People's Congress, 2 sessions this year, they are reserving quite a bit of fiscal room and maintain that flexible tone in terms of fiscal stimulus. I think this is the moment they want to use that.
How about the domestic investor in China? We talk a lot about government supports for the different sectors and the strains they've had in that economy. Is the domestic investor in a better position to put money to work in that market?
Yeah, I think to understand that, you have to understand that the fundamental setup for the Chinese economy is better than several years before. For example, the key progress is innovation across the board, which gives Chinese investor more confidence. And also, if you look at the real estate market, the real estate market has been in a downturn for 3 years in a row. But earlier this year, when we look at the real estate transaction data in terms of floor space sold, it is actually flat year to date compared to down 20-30% last year. Right now, that impact on the investment is still not so apparent. But down the road, if you are expecting the market to stabilize here, last year, in terms of GDP drag on from real estate investment, that's about 1 percentage point of GDP. So if you get that back to zero, simply staying flat, that is additional 1% support from there. Not to mention the government could do more fiscal spending.
I think it was only several weeks ago you and I had a conversation about the investing opportunity in China. Of course, before all of this news of just the past week, everything changes so fast. Longer term, are you still looking at China as an opportunity market?
Yeah, we think so. If history is any reference, when you have several days of big down market, and if you get in the market at that time, your 3 months, 6 months, 1 year, 3 year return from that point on will not be bad, actually. And I think specifically for China, you have to focus on the innovation story, because that is the key change this year. That innovation, no matter it's from semiconductor or from AI or from robot, or people are talking about, say, nuclear reactor or quantum computer, almost in every category, you can find that China recently had made progress. And in some cases, it's matching the world's best performance. So I think that will be a bright spot, particularly after all of these tariff uncertainty goes away. That will be, again, become the focal point of investor.